Well, Metcash, the wholesaler to IGA supermarkets, has announced a $375 million capital raising to help fund a buying spree. And first cab off the rank is the Autobahn retail chain. It's an attempt to shore up the group's profits after a year when falling prices have been the scourge of the big supermarkets. Neil Woolridge reports.
The jingle might belong to Coles, but even at Metcash they're saying down, down, prices are down.
We continue to see a marketing war by the chains, and the consumer has now been absolutely very well educated to only buy on specials.
Price deflation has been an issue with regards to their grocery business. That's going to play out for some time yet.
Metcash is the wholesaler to IGA supermarkets, which reported average price falls across its stores of almost 1% last financial year. Overall, the group reported a slight rise in operating earnings but a 63% drop in net profit. That includes $136 million in write-downs, mostly from its loss-making Queensland stores and the acquisition of Franklin supermarkets.
The underlying result I thought was okay, up 2.5%, which doesn't seem like a big move, but I think in this market, this environment, it's not too bad.
Metcash's liquor division was the standout performer, while earnings in food and grocery and Mitre 10 hardware, where Metcash has a majority stake, were up only slightly.
They've announced a big capital restructure with regards to how their wholesaling business and distribution network works, and we're starting to see that flow through. It's too early yet to suggest that they're actually succeeding in this new strategy.
And while that strategy is being bedded down, Metcash is already starting on its next. The company has announced it will spend $53 million to buy a three-quarter share in the Automotive Brands Group, which owns the Autobahn and AutoPro chains. Metcash's chief executive, Andrew Reitzer, says it's no departure from the wholesaling model they already use.
It's the same business. The product is different. Through these hard and tough times, they've actually done very well. In that when times are tougher, people hang on to their cars longer.
It could be a good business. It's going to be very difficult for them to switch on the earnings profile straight away. But it's not a huge investment in the scheme of things.
To fund this and future acquisitions, Metcash is planning to raise $325 million from institutions and $50 million from retail investors.
Though the company has, pretty much is on the borderline with regards to the amount of debt to equity that the company actually holds in its books, it's well within its covenants. The other very pleasing thing with Metcash is the incredibly strong cash flow that the company generates. The strong cash flow definitely supports debts at current levels.
Tom Milner says Metcash's high dividend yield makes it attractive, but the company's move into auto makes Metcash a different investment to the one BKI originally bought into.
Retail in general has been very hard, but there's been a lot of companies, and we've seen it through media, manufacturing, retail, that a lot of management have put their head in the sand and have tried to ignore it. At least these guys, for mine, are trying to be a bit proactive and go out and increase earnings stream.
Institutional investors now have to quickly decide whether to take up their shares, and the rest will have to wait until Metcash comes out of a trading halt to see if the market shares its vision for the future.